Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician, and also Portfolio Manager. Thank you so much for joining us for this week's Market Carver. Some topics we're going to hit this week. We're going to talk about international valuations and compare them to the United States. And then Andrew's going to cover a couple of technical points. He's going to look at drawdown stats and downside volume, both tea leaves for where this market may be going. I will start with the international valuation. So it's very easy for us and it's very natural to become very focused on the United States. And in many ways, we should. That is the country where we're pretty much always going to have the majority of our assets. We use the United States dollars, we spend them, so we're going to be denominated in those. However, when we focus overly on the US, we can leave aside developments upon the rest of the world. And the implications there are, when you have a period where the U.S. struggles for a long period of time, there might very well be opportunities internationally. That may or may not be the case going forward, but we certainly want to be prepared that may be the case. Like 2000 to 2010 is a good example. During that decade, the S&P 500 went about nowhere. Meanwhile, international stocks had a very good run. Are we in that sort of environment? I'm not here to say that we are. I'm just saying that we need to be aware of it. And here's a major reason why we at least need to be in tune with that. International stocks remain very cheap compared to the US. What we're looking at here are relative valuations. So we're taking the price to earnings ratio, one of the key measures of valuation. We're looking at them internationally relative to the United States. So when this chart, when you see the line up high, that means that international stocks are valued expensively relative to the US. And when it's low, you will find that chart, you will find international stocks cheaper. So if you look at the table, we can look at some specifics. So the S&P 500, the 20-year average price to earnings ratio, 15.5. All right, that is where we've been most of the time. Sometimes it's higher, sometimes it's cheaper, but 15.5 is where we settle in right now. So we've seen a major stock price correction during 2022. That's the P portion. However, you'll see we were still above average in the 16. So from 15.5 to the average to 16. So we're a little bit more expensive than average. International stocks, that's the ACWI ex-US. That's the All Country World Index is what the ACWI stands for. The 20-year average there is 13.1. So it is normal. That's really observation number one. And in a normal environment, international stocks are cheaper. That might make sense to it if you think about it. Europe is more advanced in age. They don't grow as fast in their economy. Japan, even less so. Those are two of the major geographic areas that are in international indices. So it makes sense that you wouldn't pay as much. However, they are actually significantly below that 13.1 average. So here in the US, we're a little bit above. Internationally, they're still a little bit below. And just for you engineers, we've got standard deviations on this chart. The valuation relative measure is actually a couple standard deviations away from norm. So that doesn't mean international stocks got a roar. There's about 4 different ways that relationship can be restored, but they all favor a relative favoritism towards international stocks. Now, Andrew, we'll pivot and pass the ball to you. Talk about drawdown statistics for S&P 500 stocks, I believe.
Great. Thank you, Adam. So we spent the last year, we looked at a lot of data that was less happy, less bullish. And so now we're starting to get a little bit better, more bullish data as stocks have been recovering over the last couple of months. And so I wanted to bring some bright spots to this market cover after I feel like we often talk about some of the more sour topics. So the first chart I wanted to share with you is looking at the percent of stocks that are down various amounts. So we have percent of stocks down 10%, 20%, and down 30%. And these numbers got pretty high, near the lows back in September and August. Almost every stock in the S&P 500 was down over 10%. 93% were in a double-digit decline. And if we look all the way to the very bottom, we had over half of the S&P 500 was down over 30%. And this was when the index itself was down roughly about 20, 25%. And so we're seeing a lot more decline in the individual equities just several months ago. And so where this data starts to get better and positive, a little bit more bullish, is we're starting to see these lines go lower, which tells us that we have stocks that are in less of a decline as they were just a few months ago. So you can see we've actually broken below some of those key levels. You can see we're now below the September level for percent, down 30%, and we're down actually below the summer levels from the swing up after the June low. And the S&P, we now only have 37% of stocks are still down 20%. Now that's still a high number. Of course, that over a third of the market is still within what would be defined as like a bear market, more than 20% decline. So there's still a lot of road left to this recovery, but we're making good steps, we're making good progress. And that's all we can really ask for at this point, as we do continue to see some recovery within the internals of the market. There's still many roadblocks we still need to get past, both from an index level and an individual stock level. But this was encouraging to see as we are seeing stocks begin to recover from some very, very low levels that were reached over the summer and toward the early fall. Now,
That's
the last
awesome.
chart that I wanted to
love this
share
good
with
news
you.
as we're starting out.
The last one I'll share with you, unfortunately, is less positive. So this last chart I have here is looking at the amount of volume that's traded in these individual stocks. Volume that goes up, so when a stock goes higher, we consider it to be positive volume. When a stock goes down, we consider it to be negative volume, declining volume. And so we can look at a ratio of these and see, are we seeing more stocks trading going higher on a larger amount of volume? That's a positive sign. That means more money is going into stocks that are going higher. And obviously the opposite of that would be bearish, when we have stocks that are going down, seeing a lot of volume come into those issues. And so one of the things that we've talked about repeatedly throughout this year in both the market Carver and the allocation meetings each week is looking for a change in character of the market. What that means is the market begins to have a certain type of character, certain type of environment when it's in a bear market, certain things that play out. Resistance holds and we see stocks go lower. We start seeing very defensive sectors are the ones outperforming. Things like that are characteristics of a bear market. Another characteristic of a bear market is when we see downside volume disappear, like it has right now, often puts an end to these counter trend rallies that we had throughout 2022. You can see if you look at the far right side of this chart, when the 1 month average of declining volume drops to that red line, and you can see on the top panel, I plotted a pretty red little dot there. You can see that's when those counter trend rallies ended. We had a dry up of declining volume. Everyone kind of turned bullish at that point, and there just wasn't enough sustainable buying to keep the index moving higher. And that's kind of where we're at right now. And so what I mentioned about having a change in character is what we'd like to see in bull markets. When markets are going higher, this type of condition gets ignored. The market no longer cares that downside volume has disappeared, and we continue to see the markets rally. So that's what we want to see going forward, is that the market no longer is concerned that there is no more downside volume, and we don't see those reversals like we did last year. So that's kind of where we're at right now. Last week, we saw that again, downside volume had dried up. Where do we go from here? And this is what's important. Does the market begin to respond to that and start to turn lower like it did last year? Or does it ignore it and we begin to start seeing that change in character that we're so eager to start documenting in the data? We'll know obviously over the next week or two kind of what the trend in the market is. And do we start seeing a shift back to more bullish characteristics? We hope so, but obviously we're going to be leaning on the data and leaning on our models to make those decisions. But we're kind of at that crossroads point right now where which type of market, which type of characteristics are we seeing being shown by the equity market in 2023.
Very good. Thank you, Andrew. And thank you, all of you, for giving us a few minutes of your time this week. I hope you all have a terrific weekend. I do have a reminder here that if we don't have the opportunity or pleasure of working with you, give us a call, 800-928-4001. You can come in and we will promise to leave you with some things that you can consider whether or not you do choose to partner with us going forward. So thank you again. Have a most wonderful weekend.